The first step for a merchandiser is you have to buy your merchandise. So let's talk about how we account for purchases of merchandise. It's pretty basic. If you're buying that merchandise for cash, you would just debit the inventory account and credit cash, because you're purchasing the inventory, which is an asset, but you're also using cash, which is an asset, to pay for it. So there's going to be a debit to the merchandise account and a credit to cash. That's pretty easy. If you were buying the merchandise on credit, meaning you owed the money for it, you would still debit merchandise inventory, but your credit would then be to accounts payable, because you would be owing them the money. You would have a liability where you owed that money. Now, often in this type of business, there are discounts that you can get if you pay for the merchandise that you're purchasing within a certain period of time. And the discounts are based on the terms that you are given by the person that you're buying the merchandise from. So typically a trade discount is something like what you see here on this invoice. The terms here say 210 net 30, which basically means a 2% discount if you pay within 10 days. If you don't pay within 10 days, then the balance is due within 30 days, but no discount will be given. So in this particular case, the amount that you've purchased is $1,200. If you pay that within the 10 days, you can take a 2% discount off of that $1,200. But you have to account for that. You know that that's what you're going to do, but we have to figure out how to put that into our accounting records. Again, most of the time when we purchase things like this, we're purchasing them on credit. We don't generally pay cash at the very beginning, and that's why you get these terms, 210 net 30. So that's what the credit terms are. It includes the amount that you owe and the timing of the payments. So when it says net 30, that's talking about net of 30 days, or sometimes you'll see EOM, which stands for end of the month. So it's within 10 days, it's by the end of the month that you have to pay that. So from the seller's standpoint, this is considered a cash discount, but from the buyer's standpoint, you would refer to it as a purchase discount. The seller sees it as a sales discount. So depending on which perspective you're looking at it from, it's either a purchase discount or a sales discount. So let's use an example here. This is how you, if you're the buyer, would account for a purchase discount. As I said before, you've got the $1,200, so you would have merchandise inventory debited for $1,200, accounts payable credited for $1,200. So you owe them $1,200. But if you do actually take advantage of the discount, you still debit accounts payable for the full $1,200, because once you've paid it, you're not going to owe them any more money. But in this case, the amount of cash you're going to pay is only going to be $11.76. because you're going to take a $24 discount. The $24 discount gets credited to merchandise inventory because it's deducting from the inventory account. The inventory did not cost you as much as you originally thought it was going to. So that's why it comes directly out of the merchandise inventory account, because you want that inventory to be at the cost basis, what you actually ended up paying for it. So this is what it would look like in your T account. You started with $1,200 debit to merchandise inventory. You have a credit of $24 for the purchase discount, so the balance there is $11.76. In accounts payable, you originally credited it for $1,200, and now you're going to debit it for the full $1,200 because you no longer owe them any money. So that's the basic way that you handle a purchase discount. Now, there is also the chance that you're going to have to return something, that you might purchase some inventory and then end up having to return some of it. So obviously this would deduct from your inventory, but it should also deduct from what you owe that particular retailer or wholesaler that you purchased from. So What would happen in this case, let's use this example. On November 15th, Z-Mart issues a $300 debit memorandum for an allowance from Trex for defective merchandise. So there's a $300 allowance here because something that you purchased was defective. So now you no longer owe that full $1,200. You're going to debit accounts payable to reduce the amount that you owe, but you're also going to credit the merchandise inventory account because you don't really have that merchandise. It was defective, so you either had to return it or you had to throw it away. So in order to deal with that purchase allowance, we debit accounts payable, reducing the amount that you owe, and we credit merchandise inventory, reducing the amount of inventory that you have in stock to resell. Same thing would be true of a purchase return. If you actually return something to the company, then you would do the same thing. In this case, this is the first thing where you purchase the inventory. So you purchased $1,000 worth of merchandise, so you owe them $1,000. But then you returned merchandise to the seller, so you do the same type of entry. You're going to debit accounts payable because that reduces the amount that you owe, and you're going to credit merchandise inventory because that reduces the amount of inventory that you actually have to resell. When you actually pay it now, you're only going to pay $900. So your debit goes to accounts payable for $900, reducing accounts payable to $0. But in this case, you now are able to take the discount, and you got a discount of $18. So again, that comes out of the inventory amount because you're reducing the cost basis of your inventory. So the actual cash that you send is $882. So this is how we handle purchases and purchase allowances and discounts. Now, there's another piece to all of this because generally speaking, when you buy something, there's a transportation cost, and somebody has to be responsible for that. And that's generally agreed upon ahead of time as to who's going to pay the transportation cost. That's what it says here. The buyer and seller must agree upon that. The point of transfer is called the FOB, free on board point, which determines who's going to pay transportation costs. So you're going to have to get used to understanding what these different abbreviations mean. FOB stands for free on board, and it is going to help you determine who is going to be responsible for paying the transportation costs. So if you look down here at this chart, FOB shipping point means that the buyer is going to pay the transportation costs. So if on your invoice you have agreed to FOB shipping point, then the buyer is going to pay those costs. If it's FOB destination, then that means the seller will pay for the transportation cost. And that's usually added to the amount of the invoice. So here's an example. The $1,200 purchase on November 2nd is on terms of FOB destination. This means Z-Mart is not responsible for paying transportation costs. When a buyer is responsible for paying it, the payment is made to a carrier or directly to the seller depending on the agreement. The cost principle requires that any necessary transportation cost of a buyer be included as part of the cost of the purchased merchandise. So, if Z-Mart has a $75 freight charge, it gets charged directly to the inventory because it becomes part of your cost of the inventory. So in this case, they would debit inventory for $75 and they would credit cash because they're paying it for $75. So if you're the buyer and you're responsible for the transportation cost, it gets charged directly to the inventory account. It becomes part of your cost of goods sold. So here's a little summary. Purchases are recorded as debits to inventory. Any later purchase discounts, returns, and allowances are credited, so they're decreases to merchandise inventory. But a transportation in, if you're responsible for the transportation cost, it's debited to the merchandise inventory because it increases your cost of the merchandise. So that is kind of a basic summary of how we handle purchases and then we'll turn to what it looks like from the side of selling the merchandise in the next video.